righty, folks. We have hit about our time to get started here.
Right.
So we're going to get going. This week we have just some interesting tidbits about tax advantage charitable giving. Tom here is going to talk over just sort of the tax portion. I'm going to kind of talk about how it could be implemented in the payroll system. And at the very end, I am going to do another payroll reminder just with our upcoming deadlines coming up. So a little recap on that. So without further ado, I can get us started here.
So most people are aware of the fact that when you give to a charity, you probably get some sort of tax benefit out of that. Let's say, most charities, they're not going to get into the nitty gritty of exactly how that works. It's not really their business, because it really depends on your specific financial situation. So kind of what we wanted to highlight was what it's going to look like in ordinary circumstances for charitable giving, and maybe some more advantaged ways that you might be able to give to charity that might not be obvious if you're just thinking about giving money. So the biggest change as part of the tax bill last summer made it so that even if you don't take the standard deduction, every individual can deduct up to $1,000 of charitable giving on their 2026 tax return. So married filing joint, it's $2,000 total. It's pretty nice. You could actually able to do that because in the past, it was only available if you were itemizing. And with the standard deduction as high as it is now, most people do not itemize anymore. So they really weren't getting any benefit out of any charitable giving that they were doing. So that's a nice little change that we can look forward to. As far as if you are itemizing, one of the big changes was there is now a 0.5% floor on your charitable giving. So let's say you have an AGI of $100,000 and you give $500 to charity. That's the 0.5% AGI. Well, that $500 is no longer going to be enough to be able to actually deduct anything. So maybe you gave $1,000 instead. It's now only a $500 deduction on your itemized deductions. So a little trickier in that regard, but there are certainly ways that you can still be able to take advantage of maximizing your deductions. As far as how much you possibly can give, maybe you're ready to just, you had a really good year, you want to donate as much as you possibly can up to those deductible limits. It is going to depend on what type of charity you're giving to. So what most people would think of as a normal charity is a public charity. They're getting donations from a wide variety of donors, and there's not really a private element to that charity at all. Pretty much if you think of any big charity you might give to, they're almost certainly going to qualify as a public charity. When you're giving to public charities, you can deduct up to 60% of your AGI if you're giving cash, and up to 30% if you're giving appreciated stock, which we'll talk about more in a minute. Then you have private foundations. So these are foundations that might only receive contributions from one or a small pool of donors. And what's going to matter here is whether or not that is a operating or non-operating foundation. Non-operating means it literally does nothing but give money to other charities. And that's how most foundations work. The point of it is to generate funds and give them to other charities so they can actually do the charitable mission. As opposed to an operating foundation where it's kind of a little bit of both there. So there is a charitable mission that they're acting out and they're using their funds to fulfill that mission. But the source of those funds is not necessarily from the public at large. It still might be coming from one or a small pool of donors. If you're giving to the private operating foundation, you can give up to 50% of AGI if you're doing cash, and up to 30% if it is appreciated stock. So pretty close to if it is just a normal public charity. If it's a non-operating foundation, which is what's going to be most popular for folks that have a lot of money that they're going to be contributing. That's where the limits are a bit shorter. You only do 30% of AGI for cash and 20% for appreciated stock. In all of this, what is also new this year is that 35% cap on deduction benefits. So even if your marginal rate is in the top bracket at 37%, you're only still able to reap a tax benefit of 35% for every dollar that you're deducting. So a few common strategies that you can use to kind of bump up the tax benefit of what you're actually giving to charity. The biggest one is always going to be donating appreciated stock or other business interests you might own, whether that's your own personal business or maybe a private venture that you've invested into. It doesn't necessarily need to be publicly traded security, but what you can do is if you donate the stock that's appreciated in value, not only are you able to deduct the full fair market value of that security, but you're also avoiding the realization on that capital gain. So let's say you bought a stock, it was worth $10 a share back when you bought it. Now it's worth $100 a share. It did really great. And your options, if you want to contribute the proceeds of that to charity, are either sell it and you're realizing $90 a share in capital gains, or if you contribute the shares itself, you're still deducting the full $100 a share. You just don't have to realize those capital gains. So that can be a really advantageous way to give to charity because you're maximizing your potential savings in that regard. Another potential option is a donor advised fund. So we talked about those private foundations where the limits are a little more strict as far as how much you contribute. There's also a lot more legwork that kind of needs to be done on the administrative side for managing that private foundation and kind of the compliance requirements that go into it. If instead you give to a donor advised fund, that is still considered a public charity. So you can give up to those 60% limits if it's cash. But it has a nice benefit of you're able to contribute a whole lot at once if you're looking to accelerate your contributions. So given that there's this 0.5% floor now, and maybe you aren't going to necessarily be able to itemize every single year, bunching all of your contributions into a single tax year might be more advantageous for the maximum tax benefit you can get, especially maybe if you had a really good income year this year and maybe next year is not looking like it's going to be quite as advantageous. You can accelerate that now, maximize that deduction now without necessarily losing out on any investment potential. So maybe your goal is, you want to give over several years to a certain organization. By first donating to the donor advised fund, you get that donation, that charitable contribution deduction immediately and can continue to invest those funds so that you can contribute to the intended charity over time. Another very powerful vehicle for charitable giving is a charitable remainder trust. So this is a good vehicle for folks who are in retirement and they have assets that they're living off the proceeds of. Especially if you have highly appreciated assets, kind of like the donating stock bit that we were talking about. What you can do with a charitable remainder trust is contribute whatever assets you want to, whether it's highly appreciated assets or income generating assets, put those into the trust. It is an irrevocable trust. So once you put those assets in, there's no way to get them back. And then that trust can sell those assets and reinvest them as it sees fit, with the intention of when you pass away, those assets would be donated to whatever charities you've identified. The real powerful benefit is that while you are still alive, you can still draw income from that trust. Now, it needs to be set up ahead of time. It all needs to be predetermined, but it allows you to continue to have a source of income, usually in retirement, to live off of. But once you do pass, then all of those assets can go to the intended charity. So there's a deductible benefit up front, and there's a charitable benefit on the back end. And certainly there's going to be a potential massive benefit of not having to realize capital gains on any highly appreciated assets you're contributing. Another one we get quite a bit asked about is whether your business can contribute to charitable contributions. If it's a C Corp, The answer is usually a pretty straightforward yes. You can give up to 10% of the net income to a charitable cause and deduct it just like normal. When you're an S corp or a partnership, it's a little trickier because those entities themselves don't pay any income tax. So that deduction is really just flowing through to you personally anyway. So it's not really any different than if you had just written a check from your personal bank account. But what can be much more powerful is if there's an avenue for your business to sponsor a charitable organization through whatever avenue they have available. This might look like sponsoring and marketing at maybe a trivia night they're hosting, or it's a sports team. Maybe you can sponsor the jerseys, something along those lines where there is a real marketing benefit to your business and you're paying an appropriate amount for that marketing benefit. No longer is that a charitable contribution, that is a bona fide business expense. And so you can write that off as a business expense just like you would any other marketing. So that can be very powerful as well. One really great mechanism I wanted to highlight is the qualified charitable distribution. So imagine a lot of folks, you're going to have a traditional IRA or a 401k in retirement where it was pre-tax when you put those funds in and they're taxable when you take them out in retirement. And so if you're planning on giving to charity anyway in retirement, I know a lot of folks do like doing that. If you use the qualified charitable distribution, it can be a far more advantageous mechanism than just writing a check. So essentially, the funds come directly out of your traditional IRA or really any pre-tax IRA and go directly to the charity. And by doing so, it completely skips any taxation. It's not just deductible, it's not even income for you. It doesn't count towards your AGI. And that can be extremely powerful, not only for reducing your income tax burden, but it can potentially lower your Medicare premiums because your AGI is what's going to be used to calculate those. So by reducing your AGI, you can reduce those premiums. And there are usually AGI limits on certain other deductions and benefits that you might be able to get otherwise. And so by reducing your AGI itself, rather than just your taxable income through a deduction, it can really be quite advantageous. The only real tricky part here is that you do need to be at least 70 and a half years old. So that's getting close to that RMD age, but not quite there. And it does need to be from a pre-tax IRA account. So if you have a traditional 401k, you would need to roll over those funds to an IRA first, and then you'd be able to potentially take advantage of this. Another great benefit is that if you are old enough where you do have RMDs, this satisfies those requirements. So you don't necessarily have to be taxed on your whole RMD. Part of it can be going towards this charitable contribution. So one last thing I wanted to point out is many states also have additional tax benefits beyond the normal deduction, and they might offer an actual tax credit for your charitable giving. Now, almost always this is going to be directed towards specific charitable causes, and it's not just going to be a blanket give to whoever you want. Each state's different. Each state has different credits that they might allow. Not all of them have credits, and of course, not every state has state income tax. So it really depends on what state you're being taxed in and whether or not those credits are available. I know Missouri, that's where we're located. A lot of our clients are located here as well. There are a wide variety of credits that are available. The ones I've highlighted here are that for food pantries, if you're making a charitable contribution to those, that is eligible for up to a 50% credit. So you donate $100, you get a $50 credit on your state tax return. And so that can be quite powerful. The next highest ones, because most of the other ones in Missouri are in that 50% range, the only ones that are really much higher than that would be giving to maternity homes, where there could be a $70 credit, and giving to the program that they call Mo Scholars, which is a scholarship program for private education institutions. So mostly, I think, like private grade school and high school type stuff. And those are eligible for even higher credit rates. I know in Illinois, theirs is a little more straightforward. Essentially, if the fund you're contributing to qualifies as a qualified community foundation, that's going to be eligible for that 25% credit. We have a lot of clients in Ohio as well, so I wanted to point out their credit system as well. And it really is just the scholarship donation credit. Similar to Missouri's, I believe theirs also counts towards college scholarships as well. But there's some very powerful tax credit opportunities for specific directed charitable giving.
All right, and now I think it is kind of my time to shine. So I'm going to kind of talk about here both setting up payroll in the system, like how you would have employees deduct their own charitable givings, and kind of just like why employees would want to deduct charitable givings, some benefits, some pros and cons, that kind of thing. So often employees are kind of given that option to set up payroll deductions when they first join a company. And you can actually be setting up like withholding in the same way that we do, your taxes and all that. You can set that up with a charitable giving as well. So essentially, the way that's going to work is you're going to be able to put that in the payroll system. You're going to be able to say, all right, Ted wants to take out $10 every paycheck to be able to throw towards this charity. And it's basically set up the same way within the system as the taxes when it comes to that. It's going to be a deduction. You've heard me say this on a couple different topics now, like medical insurance, reimbursements, that kind of thing. Like a lot of these, they're all going to be housed in the same part of the system. And so, they're going to be set up very similarly. They can be matched similar to certain retirement plans. So this can kind of increase how much giving you're doing. So if you have an employee who is doing that, where they're given $10 a paycheck, you can kind of match what they're doing. That can increase how much you're giving on your end, and also then the employee's giving. So, you're kind of getting a double dip on that there. So then the employees can also claim these as deductions on the W-2s at the end of the year, although this is post-tax, so they won't be getting that as a pre-tax deduction. And the one major drawback that I did kind of want to point out here is these donations aren't portable. So if the employee leaves the company, the donation stops. This can be like a really nice way to set up donations, because if you have a whole bunch of folks who are just giving a little bit during each paycheck, and this does, typically it's an easier sell to someone to, hey, do you want to deduct a couple bucks a paycheck for this food pantry, as opposed to, hey, we hit the end of the year, do you want to donate $2,000 to it? So it's kind of like a nice strategy to offer your employees, like, hey, there are some benefits to this. You're able to donate to a good cause, and it's not going to be a big significant chunk of change right out of the paycheck all at once. So that's kind of one of the big benefits to having your employees set up on this like withholding deduction kind of method. So common situations here, I've seen a lot of annual giving campaigns. So a lot of companies will hold once-a-year campaigns where the employee pledges a total amount to be deducted over the next 12 months. A lot of times you'll see charitable giving stuff come up during disaster relief times. So, there's all kinds of special drives. Out on the East Coast, there was a bunch of hurricanes not too long ago, and I saw some disaster relief kind of showing up for that. Or out here in the Midwest, when we've got tornadoes and stuff, you'll see them pop up with that kind of stuff. So they'll do these. They're more of a short term as opposed to those annual giving campaigns. But they're nice to pop up when the community needs help, and then you're able to help throw some money their way. And then there's also bonus giving. So once you kind of have your charitable giving method set up, your employees can choose to donate portions of their bonuses through payroll as well. And so, they could go through, designate, hey, I do want to put 10% of this bonus towards the charitable giving. We're able to set that up in the payroll system as basically a one-time deduction from their check. And then we can, if they get a nice bonus at the end of the year, we can basically get a little extra on top of what they've either been withholding, or if you had a disaster relief or whatever you guys were doing throughout the year. It's just kind of a way to get a little extra on that if the employee wants to. And, looking into just some of the studies and stuff about it, it does seem like, again, with both the withholdings and with the bonus givings, like I said, it's not just a huge chunk of change at the end of the year. And especially with the bonus, it's already something that's kind of a little additional onto their salary. So people are a little more willing to give pieces of that for charitable giving. Plus, you should explain to your employees that it is deductible off their W-2. So then you can kind of sweeten that deal and be like, hey, I get that you're giving this money away now, but you'll be able to deduct it off your taxes. And so it is a benefit to you and to the people who are getting that charitable. So just kind of like I wanted to outline some benefits for employees. I isolated nonprofits and then kind of employers as well, like why you would kind of want to do this, why you want to push your employees towards this. So like I said, it's an easy way to support these charities instead of just trying to force your folks and giving like a bulk chunk, which forcing folks into giving is not legal. So just keep that in mind as well. It does potentially reduce the taxable income. It makes large annual donations much more manageable, like I've been saying, by splitting them into small recurring donations. And a lot of times folks will set that on their deductions, and then they'll kind of forget about it. It'll go to the back of their mind. They're not really considering those $10, and they do really like accumulate by the end of the year. Or if you keep the employee for a long period of time, like I said, there's that downside if they leave, they aren't donating anymore. But if you keep someone around forever, then they're going to be continuously deducting that from their paycheck. So it's sort of a yin yang with that. It's only a negative if you've got a lot of turnover, I suppose. If you're a nonprofit, it increases your donor retention and it's sort of a reliable income stream because you've got a bunch of people working for you. They're already throwing a couple bucks a paycheck into your nonprofit. That's much more reliable than having to wait for individual credit card transactions, someone's donations, et cetera, et cetera. That can kind of get you just a nice, reliable income stream because your folks are directly paying into that. And then for employers, it's going to boost your employee engagement. Like I said, people are way more willing to give $5 a paycheck than they are $2,000 at the end of the year. It's going to enhance your brand. If you're one of those companies that likes to be like, hey, look, these are all the lists of great things we've done for the community, for whatever we're fixated on. You're able to kind of sell that and be like, hey, we gave X amount of money this year. We're a responsible business. We're doing all kinds of neat stuff for our community. We're helping out. We're engaged. That sort of thing. It's a very nice visual for your business. And then I am going to kind of pivot to just my reminder section here. We are coming up on the deadline of 4:30. So you're probably getting a ton of payroll relief automated messages right now. It sends out tax notifications on if there's anything due for you, but we're also reaching out to folks like Connor and I are actually trying to reach out and contact you if there is any sort of balance or large balance at the end. There were a couple situations where either your unemployment wasn't set up right when you came on with us, or maybe we got a rate that changed midway through February. We didn't get that UI rate till a little later on. So there could be some things like that. We'll reach out to you. We probably already have at this point if we've noticed something like that. But I just want everyone to be aware, and we're not trying to charge extra funds. If you've been withholding this whole time, you should be good to go. This is really just for if there was either a missing UI number. If you're on the direct debit system, just be aware that the state, basically the way that works is we file a form, the state gets the form, and then they try to bill you directly with that information. So just be aware that, so like New York is a great example of this. They're basically going to pull that whole total out at the end of the quarter. Again, payroll relief has sent out notifications. We've been reaching out to folks to just let them know this as well because we don't want anything to bounce or anything like that. But if you get anything from payroll relief and you see, oh, hey, New York is pulling $2,000, and you're like, wait, hold on, wasn't I withholding those taxes? Just keep in mind, New York doesn't do it that way. They use a little bit different of a method. There's a couple other states that do this as well. Again, we should have reached out to you already, but I just want to make it very clear that is a bit different of a setup. And then also, like I've stated this before, different states have a lot of different methods, different tax rates, sites to file on, etc. Please be aware that the process may vary. So if you get one thing from Missouri last week and you get something this week from Illinois, it's just because they're running on a little different schedules. Things have been filed at different times. Not everything is going to line up one-to-one if you've got a multiple state situation going on. So just be aware, like things are not going to happen in the exact same order. They're not going to happen the exact same way. Things won't be the exact same price across states. Just be very aware of that. And I think that's pretty much all I have for the reminders. We're getting pretty late in the game here, so most everything is filed. If you do have any questions, please do reach out to me and just, I really don't mind, clarifying things, making sure if you're worried about something being filed, I'd rather you reach out to us now and have me look into it than 2 months down the line we're trying to chase down a tax notice and you're in a situation. So if anything looks funky at all with anything we've been sending, do not hesitate to say, hey, what's going on there? Can you look into this for me? Because we can either look into it and tell you, hey, yeah, nothing's wrong. A lot of times what's going on now with discrepancies is there's pending payments in the system that are applied, they're already done, but they just haven't actually gone out and been sent to the government yet. So a great example of this would be, I recently had someone reach out because we filed everything for Illinois and it wasn't showing the payment on their end. It was just because that was pre-funded. It takes like 5 days to go through the system. So just if there's anything funky, do not hesitate. I will look into it. I can shed some light on it. Make you feel a little better. Hey, it'll take X amount of days to process, and then if something is messed up, we've still got 6 days to get everything in and taken care of. So I'd rather get you in now. Don't want anyone to have any P&Is. That's why we're trying to send out all this information to make sure you've got, some eyes to review it. And I think that is the end for today. So as always, we'll have another one of these again, same time next week. I don't think we have a topic yet, but we'll send out information on that on Monday. And I hope to see you guys then. Oh, and as well, this will be posted on YouTube. They're always posted on YouTube. Please feel free to share. If there's helpful information in this, feel free to share it to anybody. It doesn't have to just be other clients. So, spread this out. Make sure that, you're watching these if they're useful for you afterwards. So thanks, folks. Hope you have a good weekend, and we will catch you next Friday, same time.